As a brief introduction to the session this week, I want to talk a little bit about merchandising inventory. Merchandising inventory is talking about a very specific type of business. In this business are retailers, wholesalers, and manufacturers. The basic concept, or what makes these businesses unique, is that these businesses actually sell inventory. So a manufacturer manufactures a product. This product becomes finished goods and inventory, and these are sold to wholesalers, who then resells this to retailers, and then the inventory ultimately is sold to a customer. So again, the unique feature related to merchandising activity is that inventory is a significant function related to the activities as well as the way the financial statements are presented. What we see here is essentially the flow from the income statement. Now you notice that there's something unique about this, and we have a line item that's called gross profit. Gross profit is simply net sales minus our cost of goods sold. We'll talk about cost of goods sold in just a minute. From gross profit, we have expenses. These expenses could be marketing expenses, administrative expenses, and other expenses, and then we get to the point where we have net income. But again, the takeaway from this slide is that gross profit is very important to a merchandiser because it explains how much gross profit the organization is making from the sale of its inventory. So when we talk about cost of goods sold, this is the expense related to inventory. We need to understand this in the context of an inventory system. What you see here is the inventory system that is called a periodic inventory. A periodic inventory system is where inventory is counted at the beginning of the period and at the end of the period. So what you see at the top line here, we have beginning inventory. We add to this the net purchases. Beginning inventory plus net purchases gives us the merchandise available for sale. Then what the organization does is that it does a physical count of the ending inventory, and once we subtract ending inventory from the merchandise available for sale, we get a number that is called the cost of goods sold. Now, the primary limitation of a periodic inventory system is when we calculate our cost of goods sold, we only know that that inventory is no longer there. We're assuming that it's sold, but it's very possible that some of that inventory could have been stolen, could have been damaged, or in some cases could have expired. So there are limitations to a periodic system, and in another discussion we're going to talk about a perpetual system. When purchases take place related to inventory, we need to understand that inventory is an asset. An asset is a naturally occurring debit account, and what we see here is the purchase of inventory is a debit, in this case a debit of $14,000. Corresponding to this, in this case what we've done is we've paid cash for the inventory, so they're crediting cash, but also we could have bought this merchandise on credit. If we bought the merchandise on credit, the credit is not going to be cash, but the credit will be accounts payable. One of the unique features related to merchandise inventory is that when inventory is sold from one party to another, there is the possibility that a purchase discount is given. The primary reason for the purchase discount is to encourage the buyer of the inventory to pay their bills early. It encourages cash flow, and overall it's a very good thing for the organization. So what we see here is we see a diagram of time, and the idea is that inventory or purchases that are purchased on credit should be paid within 30 days. So what we see here on the bottom is that we have 2/10, comma, net 30, or N/30. Essentially what this is saying is the purchase discount is given of 2% if paid within 10 days, and then the net of this is due at 30 days. So if you don't take advantage of the discount, you've got to pay your bills within 30 days. So what we see here is the Jason purchased $27,000 of merchandise. So the merchandise inventory is $27,000 to inventory, and then the accounts payable is $27,000. Now, what's taking place is that the Jason pays the bill within 10 days. So within 10 days, what's taking place is that accounts payable is removed because we no longer owe that $27,000. However, we paid cash of the discounted rate, which is $26,460, and then you notice that the credit goes to merchandise inventory. So the idea is that the asset account, which is merchandise inventory, is net of discounts, and also, which we will talk about later, also includes any shipping charges or insurance. So merchandise inventory is everything involved with the cost associated with that inventory. I want to look at this same transaction. These are different numbers, but it's the same basic transaction from the perspective of the seller. So you always need to think about the fact that the transactions, on one side we buy things, on the other side of the transaction we're selling things. So here we're giving the same scenario. However, I want to make the point is that when we actually receive the discounted amount, we're not actually reducing sales. We create a sub-account, and that sub-account is sales discounts. So it's slightly different as opposed to the buyer of the inventory. Now we're looking at the seller of the inventory. And you notice a couple slides before we used the term net sales. Net sales represents our gross sales minus discounts minus returns. So it's very important from a metrics perspective, from a monitoring process, that the seller of the inventory is able to account for these types of transactions. And this is what we see here, is that the sales discount is a separate account. It gets closed out at the end of the year, and what's reported is net sales. So thank you very much for your time, and I hope you enjoy the session this week.